That's when you'll see more of that money flow into gold. And that's when I think it will be, to say, I call it the wet bar of soap time. Everybody grabbing for it. I think that would be soon, too. What does that mean? It means the money flow out of the stock market doesn't rush into silver futures or gold futures. It goes into miners. Miners are cheap. That's a virtue. They've proven they're not going down anymore. And on a relative basis, they've got a lot of dynamic potential on the upside. And I think the money from stock market longs will move into gold mining long positions. And I'm telling you, the NASDAQ 100 is trading above and below our key number last week. And even, if you close much down this week versus last, you're going to break our number, in which case we think the process is really underway. Because again, NASDAQ 100 is the leader.
Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pinned comment. Stay ahead of the curve. Don't miss out.
We pointed out in August of last year, a couple months after our breakout in March, that likely there would be price chart type selling around 3,000. Well, one, because it's a round number, and we know idiots love round numbers, so they like to play round numbers, okay? Like $200 gold back in 1975, happened to be a round number. Now, the 1980 peak wasn't a round number, but anyway, they think 3,000, it's a nice big round number. And so you had 3 weeks of selling at that same level, just below, 0.5% below 3,000. And we said there might be some resistance there. And I think it will be the type of resistance we've just seen, which is to say, ho-hum resistance. Just pause. And when you go through that, people say, well, hey, where's it going? And all these big brokerage firms that analyze gold that we see reports from, they have a target of, about 3,000. Then suddenly they change, 3,100. But 3,300, and they keep raising it. But it's sort of silly. They don't realize that even if you just look in the past, over the last 50 years when gold was legalized in the U.S., there have been 2 moves that were at least eightfold. And there were different time durations. One took 3.5 years, 1976 low to 1980. And one took 11 years from 2000 to 2011. But there are eightfold moves. Well, if we had an eightfold move, we'd be $8,000 gold. And we're not projecting that as a target. We're just pointing out the fact that gold has done this before. It's no big deal to do it again, especially given the fundamental factors that are in play and becoming more in play now in the world and in markets and so forth, especially when bubbles break, because then money does flow elsewhere. Speculated it could go based on certain metrics they look at, not technical, go up in the 20,000s. I don't know. We're not projecting a given target. We're just saying there will be an acceleration phase. There certainly was, in the move to 1975 high, then the move up to 1980. There were phases in the last year of the move where suddenly it changed. It was no longer normal action. It was abnormally upside. And we haven't had that. We've gone to 3,000 in layered, cautious staircasing process. And I think that's about to end because factors will shift. And the main one, again, is the stock market. And we know that the other factor, aside from money flowing out of that market, will be central bank response.
In today's news recap, gold prices are forecast to rise another 8% this year. The price of gold has surged more than 40% since the start of January 2024, repeatedly shattering records. Goldman Sachs research forecasts the rally in gold will continue amid demand from central banks. The price of the precious metal is predicted to climb a further 8% to $3,100 a troy ounce by the end of 2025, analyst Lena Thomas writes in the team's report. The team's previous projection was for gold to rise to $2,890. The increased forecast is underpinned by higher than expected demand for gold from central banks, which have been increasing their reserves of the commodity since the freezing of Russian central bank assets in 2022 following Russia's invasion of Ukraine. As well as stronger central bank demand, Goldman Sachs research anticipates a boost to the gold price from increased purchases of gold ETFs as declining interest rates make gold a more attractive investment. Those factors may be somewhat offset by speculators reducing their net long positions on gold in futures markets, which is projected by Goldman Sachs research to weigh on the gold price somewhat. Net long positions are currently very high as concerns of sustained tariffs from the Trump administration drive investors towards safe haven assets, including gold. But continued uncertainty, whether it's about tariffs, geopolitical risk, or fears about high government borrowing, could also push speculators to increase their long positions in gold. This scenario would drive the gold price as high as $3,300 per troy ounce by the end of 2025, Thomas writes in the report.
If you look at it carefully, it will swing better than gold and then swing worse than gold. It's more volatile. So there's some up moves. For instance, when gold was capped at 2,400 for several months, silver wasn't. It went from like 31, 32 up to 35. And gold didn't go through the 2,400 zone, and yet silver did. So it exceeded gold then. And then in pullbacks, invariably, silver will underperform gold. We're watching the spread relation between silver and gold and the miners and gold. And technically, we're watching it. And we see on the spread charts trend structures such that if you get in the next few days or weeks, even modest outperformance by the miners to gold and outperformance by silver to gold, that you're going to break those spreads out of a process of correction that's been going on in those spreads since mid-2020 to 2021 highs when silver outperformed gold and the miners outperformed gold. Since then, they have corrected on a performance basis, and they've got breakout levels not far above, and where at levels you won't notice just looking at their price charts. This is a spread relation, don't look at their price charts, that indicate upside resumption. And this is what happened, for example, in silver, in the 79 to 1980 move, the last year of that bull market, and also in the 2010 to 2011 surge, which is the last year or so of that bull market, silver vastly outperformed gold. It's like exploded. We think that the miners in particular have demonstrated over the last 10 years, since the 2015 bear low, if you look at their spread chart versus gold, they're actually at a higher level than they were then. Now, it's still at a very low range historically of the miners versus gold compared to where they were, for example, back in prior to 2009. They were much higher relative levels. But it's a base, and they've not gone back to the low of that base. Now, what does that mean? It means they've demonstrated over the last 10 years, we're not going to underperform gold anymore. And sure enough, that spread relation, if you take the current reading of the spread, it's higher than it was at the 2015 bear low. So their underperformance to gold ended then. And since then, yes, they've gone range bound in performance to gold, up and down, but what you call a par performance. But they're actually higher net price wise, measuring from the 2015 low to their current price, than gold is relative. For instance, XAU index as of last week's close was 3 times its low of 2015, whereas gold is 2.7 times its low in 2015. So actually XAU index, which is still at very low levels in relation to gold, is been outperforming gold. Minor amount, but outperforming. Nobody would believe that. They think, oh, it's underperforming. The question is, if you could break it out of this basing pattern on the spread, we think gold miners could triple their current relative performance to gold over the next year or so. In other words, if we enter an acceleration phase in the net price of the monetary metals, we think we're also going to see silver outpace gold, and get up to more or less normal levels like 2% of gold, whereas right now it's 1.12% of gold, which means a doubling in its value to gold. And the gold miners, let me give you an example. Gold mining, the XAU versus gold is like about 5.5% of the price of gold. You go back to the 1980s through 2006, 2008, its low spread rating was 17.5%. It had been in a range between 17.5% and 35% of the price of gold, and it collapsed in 2015 to 4% of the price of gold. That's like free, okay? I mean, it's not going to zero, okay? And it's now 5.5%, so it's higher than it was then. But if you take it from its current level and run up to the bottom side of that multi-decade relative performance and bump the floor, the old floor, it's a tripling in the current value of the miners relative to gold. And we think that is